Have you ever watched a Bitcoin chart soaring and felt that sinking feeling that you missed your chance to get in? In 2025, that feeling is more common than ever. But what if I told you that the game is just getting started and you haven't missed a thing? This is your ultimate guide to starting your crypto investment journey right now. What is crypto in 2025? The basics. Simplified cryptocurrencies are a new form of digital or virtual currency that exist exclusively online and are secured by cryptography. They are not physical assets like cash or gold, but are built upon a decentralized network that utilizes blockchain technology. This means they operate without a central authority, such as a government or bank, which gives them a unique position in the financial landscape. The foundation of cryptocurrency is blockchain, which can be understood as a digital database similar to a ledger or a giant spreadsheet. Any new information, such as a financial transaction, is time-stamped and stored in a block that is then chronologically linked to other blocks, forming a secure chain. For a beginner, the most important features of this technology are its decentralization, immutability, and consensus mechanisms. Decentralization means that control is transferred from a central entity to a distributed network, which reduces the need for trust among participants. Immutability ensures that once a transaction is recorded, it cannot be changed or altered, making it a permanent record. Finally, consensus requires that the majority of participants in the network agree to validate a new transaction before it is added to the blockchain, which prevents tampering. The true power of blockchain technology for a new investor is how it intersects with human behavior. The immutability and consensus mechanisms create a system based on code as law. This removes the need for an investor to place their trust in a centralized, fallible institution like a bank, and instead places that trust in a transparent and tamper-proof technological system. The genius of the technology is not merely its functionality, but its ability to address a fundamental human need for security and control by solving the problem of trust. Why you should care. The investment case for crypto investing in cryptocurrency offers several potential benefits, which is why it has captured the attention of so many in 2025. First and foremost, digital assets offer high growth potential due to their evolving technology and marketplace. While investing in stocks can help grow wealth, a different asset class, such as cryptocurrency, can help diversify a portfolio, reducing reliance on traditional assets like bonds and equities. For some investors, crypto can also serve as a hedge against inflation, protecting capital from consistent devaluation. Your first purchase, a step-by-step guide. Once an exchange has been selected, the process for making a first purchase is straightforward and can be completed in a few simple steps. First, sign up for the platform by downloading the app and entering a valid email and phone number. Next, complete the verification process, which involves providing your full legal name, a government-issued ID, and a selfie. This Know Your Customer (KYC) step is a legal requirement that helps exchanges comply with financial regulations and is now standard practice in the industry. With verification complete, the account can be funded by connecting a bank account or debit card. The final step is to make the trade by selecting a cryptocurrency and executing the buy order through the exchange's intuitive interface. Mastering your mind and managing risk. The power of patience, strategies for the long haul. The extreme price fluctuations of cryptocurrencies can be a major source of stress for new investors. However, two core strategies can act as a powerful antidote to this volatility. The first is dollar cost averaging, DCA, an investment strategy where an individual regularly purchases a fixed amount of an asset over time, regardless of the price. For example, instead of buying $1,000 worth of crypto all at once, an investor could set up an automatic recurring purchase of $100 every week for 10 weeks. This approach mitigates risk by removing the need to time the market, which is a common source of error for beginners. DCA is a passive, set it and forget it style of investing that is well suited for a long-term strategy. The second strategy, often used in conjunction with DCA, is HEODL, a term that originated as a typo for hold and has since evolved into the acronym Hold On for Dear Life. HODLing is a buy and hold philosophy where an investor commits to holding their assets for the long term, riding out the market's ups and downs in anticipation of future growth. By committing to these long-term strategies, new investors can avoid the emotional traps of panic selling and buying at market peaks, which are often the primary drivers of financial loss in a volatile market. Defying your own brain. Behavioral finance for beginners. Investing is not just about understanding the numbers, it's about understanding human psychology. Behavioral finance studies how emotions and cognitive biases influence financial decisions, often leading to irrational choices. For beginners, being aware of these biases is the first step toward making more rational decisions. One of the most powerful biases in the crypto market is FOMO, or the fear of missing out. This is the anxiety that comes from seeing others make profits, which can lead a beginner to buy an asset at its peak out of a fear of being left behind. Another common pitfall is loss aversion, where the pain of a loss is felt more intensely than the pleasure of a gain. This often causes investors to hold on to losing investments for too long, hoping for a recovery. Finally, herd mentality is the tendency to follow the crowd, making decisions based on social pressure rather than independent research, which can be a dangerous practice in a highly speculative market. The most effective way to counter these biases is to have a predetermined plan and stick to it. This can be as simple as setting a regular DCA schedule and avoiding the urge to constantly check account balances, as this can trigger an emotional response to unrealized losses. It is also beneficial to actively seek out viewpoints that are contrary to your own to avoid confirmation bias. By taking the time to understand these psychological traps, a new investor can elevate their approach from a simple transaction to genuine financial education, which is a powerful way to succeed in the long term. The 2025 Market and Security Primer. The 2025 Crypto Landscape. The year 2025 is a pivotal moment for digital assets. The bull market that began in 2024 has continued, fueled by two major catalysts: the approval of spot ETFs and the latest Bitcoin halving event. Exchange-traded funds ETFs have made it possible for investors to gain exposure to cryptocurrencies without having to navigate the complexities of a crypto exchange. This has attracted significant institutional investment and has been a major driver of the market's growth. While analysts have warned that future gains may be smaller than in previous cycles, the sustained institutional interest suggests a more mature market. Perhaps the most significant development in 2025 has been the passage of landmark digital asset legislation. The Genius Act has established the first uniform federal framework for stablecoins, requiring issuers to back their tokens with high-quality liquid assets. Additionally, the Clarity Act has created a much-needed framework for classifying digital assets as either commodities or securities. This legislation brings a new level of clarity to a market that was previously marked by ad hoc enforcement. This new regulatory reality fundamentally changes the narrative of crypto from a Wild West to a codified frontier. It creates real guardrails for investors, making the asset class safer and more stable for new participants and fostering a sense of cautious optimism within the industry. Protecting your digital wealth. Once an investment has been made, the next step is to protect it. A cryptocurrency wallet is a tool that stores the private keys that give an investor control over their digital assets. There are two main types of wallets, distinguished by their internet connectivity, hot and cold. A hot wallet is always connected to the internet, which makes it convenient for daily transactions, but also more vulnerable to cyber attacks. Examples of hot wallets include those integrated into exchanges like Coinbase and Binance, as well as software wallets like MetaMask. In contrast, a cold wallet stores private keys offline, offering superior security for large, long-term holdings. These include hardware wallets, such as those made by Ledger or Trezor, and physical paper wallets. The best strategy for a beginner is to use a combination of both. A hot wallet is ideal for small daily use, while a cold wallet is a secure digital vault for long-term savings. Regardless of the wallet type, there are several essential security practices that every investor must follow. The most important is to secure their seed phrase, a series of words that serve as the master key to their wallet. This must be written down on paper and stored offline in a secure, private location. It should never, under any circumstances, be shared with anyone. Additionally, enabling two-factor authentication, 2FA, adds a crucial extra layer of security. Finally, an investor must remain vigilant against phishing scams, which often involve fake websites or unsolicited messages designed to steal private keys. Understanding Crypto Taxes 2025. Starting your crypto journey in 2025 is not just about picking a coin. It is about building a foundation of knowledge, a mindset of patience, and a fortress of security. The market has matured, moving from a pure frontier to an increasingly codified financial ecosystem. A new investor who enters the space with a solid financial plan, a trusted exchange, and a commitment to long-term strategies like dollar cost averaging and hodling is better equipped to navigate the inherent volatility. By understanding and actively defying their own psychological biases, an investor can make more rational decisions that align with their goals. The future of finance is here, and you are now ready to be a part of it. If you need more help and tips to navigate this world, subscribe to this channel and join our community. See you in the next video. The new regulatory environment of 2025 has also brought a significant change to how crypto is treated for tax purposes. Starting January 1st, 2025, crypto brokers are required to report users' digital asset sales to the IRS via Form 1099-DA. This new tax law fundamentally changes the user's relationship with their digital assets. While crypto was once seen by many as a pseudonymous system free from government oversight, it is now a recognized taxable asset class. This new reality requires a responsible guide to prepare a beginner for these changes. It is important for a new investor to understand that while activities like buying crypto with cash, hodling, or transferring assets between their own wallets are non-taxable events, selling or exchanging crypto for another asset does trigger a taxable event.